Welcome to Wealthion. I'm Wealthion founder Adam Taggart, speaking to you not from an East German gulag police prison cell. Which it looks like it.
That's what I thought it was.
Yeah, I know. I'm actually traveling today, actually up near Yosemite. This was the only place I could get that actually was supposed to have Wi-Fi. It didn't have Wi-Fi. I'm doing this off of my phone's hotspot. So we are doing this with shoestring and bubblegum, folks. Hopefully it makes it through the day. But I'm here for another weekly market recap featuring my good friend, portfolio manager, Lance Roberts, fresh from a hot run in the blistering Houston, Texas sun. Lance, how you doing, buddy?
I'm hot. That's what it is. Yeah, it's definitely heat index today is up there. So yeah, if I'm still sweating a little bit, sorry about that.
All right. Well, look, between, the low bandwidth, the fact that Lance might pass out from heat stroke, let's see how far we can get through this week. But this shows our commitment to you folks. These are the lengths we will go to bring you your weekly market recap. Now, Lance, we have a bit of a down week so far. Recording here on Friday, markets look like they're popping a little bit. Probably not nearly as much to make up for how much the week has dropped so far. You have been saying for many weeks now, this market has just been raging so, far, so quickly here that some sort of pullback, I believe last week you used the words overdue, was overdue. Correct me if I'm wrong. I think you've been warning us that you sort of expect a little bit of a cool off of about a 3 to 10% or so in the market. Could we be seeing the start of that here?
Yeah, it's very possible. And August and September are pretty notorious for that anyway. Just normally you have the month of August tends to be weak in the first half of the month. It tends to be a little bit stronger second half of the month historically. September tends to be the weaker month of the year as well. Just that's where, and also, September, October, for some reason is when you have all your market crashes. 1987, 1929, 2008, they all kind of occurred in October. I don't know why October is a month. It just tends to be the month that just happens. But yeah, the market was extremely stretched, and we had some things that were setting up here too. Well, let's just look at a technical chart. First of all, what you'll notice is, this is the market, it's really kind of since, April of this year. And you kind of see the sell-off in March. And that was that, obviously that Silicon Valley Bank, default issue. And oh my gosh, here's the financial event and this is going to be terrible. And the Fed steps in, they start their bank bailout program. And since then, the markets have been pretty much off to the races on this whole AI chase, right? Artificial intelligence. And, importantly, just, you can just see here, and particularly since May and really kind of early June, the market got very deviated from the 200-day moving average. And, importantly, as the markets were starting to go up here over the last week or so, and this is really kind of more of the kind of the point that you're looking for. Wait, let me get the right indicator here. You had this negative divergence that was occurring. If you'll notice, the MACD had been turning a bit lower here as well, and it was declining even as the market was rising. You saw the same thing in the relative strength index, and you saw it also really kind of declining from its previous peak, even though the market was still rallying, relative strength was falling. And that was really a good indication that the market underneath the surface was beginning to weaken a bit. And so a correction was likely. And so we said, hey, probably we're going to have a 3 to a 5% correction in here initially. And that would really kind of bring the 20-day moving average, that's this orange line, into focus. That's first level of support. Now, today in particular, so we broke that 20-day moving average on Wednesday, rallying back to it on Friday. So it'll be important that if this market's going to, stop correcting here, we get back above that 20-day moving average. If we fail here on Friday, and then Monday we open up weaker, then the 50-day moving average is going to become the next target. That's about 4,400 on the S&P. So, a couple hundred points off the S&P and just a mild correction here. Wouldn't be surprising if you look back here in kind of May and June, April, we had a regular retest of the 50-day moving average. So, a pullback to the 50-day here wouldn't be surprising at all. It's going to bring the bears out of the closet, and they're going to be saying, okay, see, I told you it was all a bull trap, and, here's the bear market starting again. No, it's just a correction. Here's the tricky part. We could correct all the way back to 4,100, which is that 200-day moving average. that's still a correction in a bull market. That's still not a bearish market action. Now we break the 200-day, fail there, and start to go lower. That's a bigger concern. But between but the market had gotten so extended above the 200-day moving average, we can have a 10% correction, by the way, completely normal in any given year, back to the 200-day moving average, and that's completely normal. You should expect that to occur. So nothing to be fearful of, but just that's how far the market's gotten ahead of itself in the first 6 months of this year.
All right. So kind of condensing what you just said there, you're not really going to start sweating, at least not from a run, about these markets until we're kind of flirting with that 200-day moving average. Yeah.
And what I'm actually looking for is I'd love to see this market come down to the 50 or even the 100-day moving average, which is this blue line here. I'd love to see a correction back into that range. And if it stabilizes and holds there, turns back up, we get some of these indicators deeply oversold, get the MACD back to an oversold level, it starts to turn up, give us a buy signal. That's a great buy, kind of buying opportunity to put money to work on the equity side for the end of the year. And the end of the year will probably be fairly strong. I would expect a fairly strong upside October, November, December. The reason is, first of all, that's a seasonally strong period of the year, but more importantly, you've got a lot of fund managers, hedge funds, et cetera, that are behind the curve this year, me included, because we didn't own just 7 stocks. So there's going to be a performance chase into the end of the year with these managers allocating money to markets to try to play catch up, on performance, because when they report performance at the end of the year, that's going to mean their bonuses, their jobs, and whether or not they get more inflows of capital next year or not.
All right. And as you've said, in this program before, Lance, technically, just looking at data, years in which we've had a strong run up like we've had in the markets for the first half of the year, they tend to finish the markets higher. Right now, you and I have talked ad nauseum. We will continue to in this video, I'm sure, as well, that there's a whole flotilla of macro risks out there. So, presuming that they don't exert themselves in a way that disrupts everything, you're basically saying, look, the preponderance of history is that we may actually have a good end of this year. And so, like you said, you're hoping actually that we come down and maybe test the 50-day, the 100-day moving average, because it'll create some good entry points for you to ride that recovery, or that I don't want to call it recovery, but that renewed momentum into the end of the year. Again, provided that the macro part of the picture doesn't throw curveballs our way.
Well, yeah, and this is always the case, right? What we're talking about here is purely technical. So technical doesn't account for economics or fundamentals or valuations. None of that. What all technical analysis tells you is what the herd mentality of the market is doing. You got to, as we've talked about before, the market is just a big organic pool of people, and you got half of them that are betting on the upside, and half of them are betting on the downside. Theoretically, it's not really that way because you've always got a buyer and a seller. But right now, the preponderance of people are betting on the upside. And so, you take a look at options, what's happening. I mean, it's extreme. This morning in our investment committee meeting, we spent a lot of time evaluating buying put options on some of our portfolios, because the cost of hedging, buying insurance, is so cheap that you can hedge an entire portfolio for a very small amount of money against, fairly small declines. And that's not normal, but that's the exuberance that we have going on in the markets right now. There's just nobody really expecting downside. So unless something shows up, and again, this is always the thing that we have to remember, is that the technicals are always right in the short term until something shows up that none of the market is expecting, right? And so are the markets expecting some weaker economic data? Yes. Is the market expecting the Fed to hike rates maybe one more time? Probably. All that stuff's already priced in. The market's already telling you that's not a concern. The concern is something shows up that we don't expect, some type of event. You go to bed on Thursday night, you wake up on Friday, and Lehman Brothers goes out of business, right? That's the kind of thing that derails the markets and throws all this analysis out the window. Then you have to change your game plan and work with what's going on. But right now, the technicals are very strong, very bullish. There's no reason to fight them at the moment. And yes, there is some economic data out there that is certainly concerning and worrisome. And we'll certainly talk about some of that this morning. But there's also some anecdotal evidence that suggests that maybe the worst is behind us. And we can also talk about that as well.
Great. Well, let's do both. First off, I want to maybe pat myself on the back a little bit because I think it was first 2 weeks ago where I started pointing out the fact that it looked like downside insurance was really cheap, and you seem to be continuing to corroborate that. Now the market has come off a little bit this week, but prices are still cheap. The puts and whatnot haven't adjusted too much yet.
No, you haven't had a big enough correction to really move price. Yeah, I mean, prices of puts in June of next year, as an example, they went up a little bit this morning, but you're going to need a much bigger correction to really push the cost of insurance higher. And again, how is insurance priced, right? Insurance is priced by demand, and right now nobody wants to buy put options. Everybody wants to buy call options. So there's call options will cost money. Puts, not so much, because there's no demand for them. And what drives price is supply and demand. And there's no demand, so price is very cheap. But that's also the contrarian nature of the market. I don't want to buy calls here because everybody is long calls, which tells you that probably the herd is going to be wrong at some point. The only question is when. And that could be, again, 6 months from now, and 9 months from now, a year from now. That's where they'll potentially be wrong. And that's why you want to kind of buy yourself some time with options so that they don't expire worthless on you.
Got it. Yeah. So just sort of underscoring again for folks what we're talking about. When you have the ability to purchase meaningful insurance for a low price, you should pay attention, right? Especially given that we have this market right now that doesn't seem to care about all of these big macro concerns that Lance and I talk about so often. So when you get presented with an opportunity to buy yourself some safety, it's probably something you should think about. If you've not, bought put options yourself before, I'm not encouraging anybody to go out and do this with no experience. If you're thinking about looking into this more, I just highly recommend talking to a financial advisor who understands how to use these from a hedging standpoint and get their opinion in terms of what makes most sense for you, given your current portfolio, how it's allocated, your risk profile, all that type of stuff. But Lance, I want to talk briefly about a piece that you wrote this week, kind of on this theme, which is that the bullish indicators are so bullish now, I think they're almost bearish to you, right?
Yeah. It's funny though, because I actually wrote the inverse of this article in June of last year. In June of last year, I wrote this article. I said, investors are so bearish that it's bullish. And of course, in June and July, we had July and August, we had that very big, 25% rally. Everybody was getting back bullish again. And then the market sold off into October, and we got and bearish sentiment, you got more bearish. So it's not a perfect indicator by any stretch of the imagination. But since October, obviously, that bearish sentiment has been fueling this market rally higher. Now, what's interesting is that just in the last couple of months that, we have, and again, you kind of still share my chart. I forgot this whole time I've had this chart up. I apologize. But you can see that just since May, this market really kind of took off in a sprint. And up to May, bearish sentiment was still pretty bearish. It's now gone full raging bullish with just this move over the last couple of months. And so now we're getting to the point that historically, what happens is that sentiment is getting to a level that historically normally equates to market peaks. And again, this also goes back to the put option insurance as well. Just talk about this for a second ago. Is that the reason puts are so cheap is because everybody's bullish, right? And that's what sentiment's telling you. Nobody thinks the market's going to go down, so I don't want to hedge. And and that's why volatility is low. Nobody's expecting a crash. So there's nowhere to go but up from here. That's the mentality. And of course, the herd is always wrong at extremes. The professional and retail investors are notorious for selling bottoms and buying tops. And that's exactly what you're seeing right now, is that you've got this extreme kind of bullish sentiment, and investors are literally all in the pool. So if there's nobody left to buy, what happens when sellers show up?
Right. Or what happens when there's no marginal buyer left to buy at the latest price, right?
Right. That's what I mean. The same thing. Yeah.
Yeah. So, and that's really what I wanted to dive into here was exactly this point, that sort of the herd tends to become most enthusiastic or most passionate, we'll say, at really right at the wrong time. Right now, it can last for a while. It doesn't necessarily mean this is all going to head over tomorrow, nose over tomorrow. But it sounds to me like your confidence that it could goes up the more crowded the herd is all in into one side here, right?
Well, yeah. Now, look. Also, too, this doesn't mean that I'm not saying the market's about to crash, right? That's not what I'm saying at all. What bullish sentiment tells you is that you're probably due for that 3 to 5 to 10% correction, and that'll pull a lot of the sentiment out of the market very, very quickly. And if you go back and look at sentiment indicators versus the bull market that started in 2009, we had lots of corrections along the way from extremely bullish conditions. And, they were contained within 10 to 15%. 2015, 2016, you had, 15, 18% corrections. 2010, 2011, you had, 10, 12% corrections, those type of ways. So you had decent corrections along the way, and that reduced that bullish sentiment from bullish back to bearish. But, what was important is that the last year, the sentiment was as bearish as it was during the financial crisis of 2008. It was extremely negative bearish sentiment, which, again, as we talked about then, was going to provide the fuel for that bull market rally when it occurred. And that's what we've been really seeing since October.
Okay. Yeah. So again, you're not calling for a market crash, and you have been calling for a pullback, which might be in process right now. And we'll talk about your trades in a bit, but I assume you're not making too many long buys right now, given your growing confidence of this 3 to 10% pullback.
No. We've been talking about here for weeks. We've been buying over the last 3 months. We bought some regional banks when during the whole financial bank crisis back in March. We bought some regional banks there. We bought some energy on the dip that we had there. We had added to some of our mega cap stocks in more recent months heading into earnings season. We added to Apple and Amazon and Microsoft and Google and those type of stocks. So we've already been increasing exposure. We're still underweight equities, unfortunately. I wish I was at target weight or overweight from earlier this year. It would have been a much better call. But again, there was so much uncertainty. We couldn't really afford to put our clients at that much risk. And, unfortunately, the markets did a lot better than even we assumed they would because of this kind of psychological push. So now we're a bit behind the curve, but we're still holding a lot of cash. And that's why, we're talking about this correction that we've been looking for, saying, look, we're better off waiting for a correction to add additional exposure to the portfolio. And here's the funny thing about it is that the market could correct back to where we started talking about a potential correction, which was really kind of beginning of July. Market correct all the way back to that point, which is around 4,400-ish. We're currently 4,523. So we correct back to 4,400, and you go, well, Lance, you could have just bought at 4,400, and yeah, I've round tripped it now back to where I was. But the risk reward at 4,400 on this pullback will be better than it was back in July, because now I've worked off some of the overbought condition. Stocks are oversold to a degree. Sentiment has gotten a little less exuberance. And now that gives me fuel for the market to advance to the upside from here.
All right. We talked a little bit about that last week, but I'm glad you reiterated this week, because again, shows how an experienced, seasoned financial advisor sees the tape, which can be very different from just the armchair person. Where the same number can actually mean different things.
Yeah, let's be honest, we're all just guessing at this thing. So, we'll see.
Yeah, but you have a lot more experience base to guess from. All right. Well, look, I find it interesting that this, at least the weakness we saw this week is coming, during earnings seasons, where we're now getting some, really big names getting out there and announcing. And it's been interesting. It's been kind of a mixed bag from what I've been able to tell. Some big beats, some pretty big disappointments from certain sectors. This week we had two big companies, Apple and Amazon, report. Before we talk about those specifically, can you just tell us, now that we're this far into earnings season, what it's telling you? I know when it first started, you were saying, hey, the data we're getting is maybe things weren't as bad as folks feared. Do we still have that sentiment, or is maybe some of this pullback being people saying, the guidance isn't what I'd like it to be?
No, it's actually okay. I mean, we got an 80% beat rate so far, and not surprising. Again, we talked about this before. We lower earnings until everybody gets over the bar. What is interesting is that companies aren't being rewarded for beats as much as usual. Yeah, we're seeing a few companies that, like Amazon's up, 7-8% today, after their earnings. But remember, before, when companies were beating earnings, they were up like 20%. So the rewards are not as high as they were. So in other words, a lot of the expectations so far are, the companies that are beating estimates are going, yeah, you're beating them, but not by a lot. Apple did okay, but their guidance was kind of soft. Amazon is up, but they beat earnings and estimates, but it really wasn't by a huge amount. And these are stocks that are trading at pretty expensive premiums to fair value. So in other words, what we're seeing is kind of really what we expected, is that companies are kind of meeting their guidelines, and a lot of the earnings were already priced in to the company. So buyers are going, okay, that's great, you did this, but I've already kind of paid for that.
All right. Well, let's talk about some of what we are seeing here. First off, we're seeing certain industries really disappoint, and it seems that a lot of sort of shipping and logistics companies are giving kind of grim forecasts. I don't know the company itself, but I've been seeing headlines about companies that make cardboard, for shipping boxes and stuff like that, are giving really bad estimates. Obviously, Yellow, the short haul trucking company, just declared bankruptcy. So we're definitely seeing, it seems, weakness in companies that are in the business of shipping real things from point A to point B. Some people may take that as a sign that the circulatory system of the economy is slowing down enough to hurt those businesses. Love to hear any thoughts you have on that. But I also want to talk about Apple really briefly. So Apple, I think, somewhat surprised people with weak iPhone sales. It's their third consecutive quarter of declining revenue. How material is that? And I guess, how long until the market realizes that Apple is not a high growth company anymore?
That's the big question. I mean, there's two things that go on with Apple, and this is the conversation. So here's the conversation that we have in our office, right? So Mike and I were just talking about Apple this morning in particular, because again, exactly the same thing. This is a $3 trillion company in market cap value, right? And so how do you justify valuing a company at $3 trillion that's growing earnings at a very slow pace, growing revenue at a very slow pace? This is a very mature company. They simply can't grow earnings and revenue fast enough to justify the multiples being paid for this company. But then you have to step back for a moment and take a look at retail flows as an example. And there was a great chart out earlier this morning I put on Twitter talking about retail flows. And investors are just piling in to ETFs, right? And so no longer are individual retail investors buying individual stocks. They just buy the whole ETF. It's just easier. It's cheaper. This is what they're all told. I sign up for Robinhood or whatever. I just buy ETFs. And you've got over 300 ETFs that all own Apple. So if everybody is putting their money into ETFs and you have these big flows into ETFs, which you do, you have a much bigger flow into ETFs than you do individual stocks. We've talked about this before, 30 cents of every dollar goes into the top 10 stocks. So despite the fact whether or not Apple is growing fast enough or not, the stock price keeps going up because of all the inflows into ETFs. And so we've got this real kind of bastardized market that really isn't based on fundamentals or earnings or anything else. It's based on flows now because of what happens with ETFs versus every other market. And this is why we were talking about earlier this year, 7 stocks outperforming the rest of the market. This wasn't because everybody was just piling into 7 stocks. It's because they were buying ETFs that were market cap weighted into those 7 stocks.
Yeah, we've talked about this. I think I've used the term a lot that I think Michael Green and Bill Fleckenstein used, right? The giant mindless robot, right? Yeah. Money just comes in and it just gets brainlessly allocated because you have these algorithms or the weightings of the ETFs themselves. It's just predetermined math. To your point, 30 cents of every dollar that comes in goes into these certain stocks. And Apple, I think, correct me if you think differently, but I mean, Apple, I think we can argue it may be the world's most over-owned stock, right? It's kind of in almost every ETF that's out there, right?
Yeah, that's funny. You'll find mid-cap stocks that own Apple. You'll find, mid-cap ETFs that own, it's just, it's the position of managers going, if I want people to buy my ETF, right? I got to have performance. If my ETF isn't performing, I can have the coolest looking ETF on the planet. Excuse me. And, it's got some great, fundamental gadgetry behind it. And I only buy value stocks and blah, blah, blah. So I can make you a great pitch for one. But if it's not performing, nobody's going to put money in, right? Because everybody wants whatever's performing the most. So these managers, they go, well, if I want my ETF to perform, I better own Apple, Microsoft, Google, NVIDIA, and a couple other big names like that. And then I'll put all my other stuff in here as well. But the big cap names in that are the big funds. And this was the whole scam with the ESG ETFs, which ESG sounded great on the surface. And we said back then, it's like, ESG is fine until it doesn't perform. And then everybody's going to go, ESG, what? I'm into whatever's. Now it's AI, right? ESG, what was that? It's now AI. ESG is now, no longer performing because everybody wants to be in AI because that's the new hip thing that we're doing now. But back then we said, look, ESG is they were just taking an S&P index fund and then they were just changing one name. And BlackRock was the most famous. They charged you 4 times as much to buy their ESG ETF. The top 10 holdings were exactly the same as the S&P index, except for one. And that was they inserted BlackRock stock into the top 10 holdings so that every time people piled into the ESG fund, it was boosting the price of BlackRock, which was good for, the CEO of BlackRock.
Larry Fink, yeah.
Yeah. So good for him. And they were charging you 4 times as much. Well, people caught on to that game pretty quickly and said, I'll just buy an S&P index, get the exact same performance and pay 1/3 of the cost, right? And so, but that's the problem is that all these ETFs, I'm an ESG fund or I'm an AI fund or I'm a low latency fund or whatever it is. Look at their top 10 holdings. It's the same stocks, across the board. And that's just this problem that we have. Now, does that ever get fixed? Does that ever change? I don't know. I guess at some point, maybe people kind of wake up and go, why own an ETF? I'll buy individual stocks. Maybe I can do that. I don't know. I don't know what fixes, if anything.
Well, that, and here's where I'm going with this is there how worried are you that we get to a place, let's just say that Apple stumbles, right? That it's cooling off here. Like I said, 3 consecutive quarters of negative revenue growth. Let's say that gets worse, right? And people suddenly wake up and say, hey, you know what? I don't know if I want to own as much Apple going forward, right? And I don't know if that gets manifested in ETFs that suddenly get pressure to decrease their percentage in Apple or whatever, right? But all of a sudden you have the stock that is propping up so much of the market. All of a sudden, whether it's forced selling or reduced buying or whatever, like, is there a risk that this is just sort of one of those Jenga pieces that you say, you know what, we're going to take this thing out here, and it creates a cascade in the market because right now it's just so systemically pervasive? Yeah.
I mean, ultimately, again, it all comes down to performance at the end of the day. And if for some reason Apple begins to stumble and fall and, stocks down 10, 20, 30, 40, 50%, and it's dragging on performance of these managers, then they'll eventually sell them. And when they start selling Apple, then the problem gets worse. And this is the one thing that, you go back and look at, the market last year in 2022. Yes, the markets were down 20, 25%, but there was a lot of stocks in the market that were down 70, 80, 90%. And, you look at last year and you go, well, that wasn't nearly as bad as the financial crisis. Well, it actually kind of was. If you strip out those top 10 stocks, the performance of the market was a lot worse in 2022. And that's why the average retail investor was down 35% in 2022 versus the market being down just 20%-ish by the end of the year. And that was because those top 10 mega cap stocks were holding up the market. We kind of wrote a piece on this about passive investing and used the iceberg analogy. The top 10 stocks are the part of the iceberg that you see above the waterline. What you don't see is this mountain, this massive mountain of ice that's below the surface. And that was the other 90% of the stocks in the index that were dragging down a whole lot more. But, again, it was that illusion of the passive investing that kept the market from being a lot worse in 2022. And it's also been the thing that's driving the market this year as well. So if that ever changes, I think you got real problems.
Yeah. And again, we're talking about Apple, but, there's a couple other stocks that punch well above their weight as well. Microsoft, a few other ones here that, again, if any one of them, or even worse, a collection of them, were to start stumbling, it could really create some pretty big ripple effects. And to your point about how, in 2022, the markets weren't down, the indices weren't down nearly as much as many individual stocks, right? And that's because it was these big stocks that were kind of buoying everything, right? And so that does work in reverse, where you could have a market where the bottom 90% of stocks are doing good, doing quite well. But if these top 10 stocks, for some reason, if the bloom comes off that rose, they can bring the indices down way more than you would expect because of in their pervasiveness. Look, I'm not predicting this is going to happen, but I do look at how dependent the total market value is on these very small number of stocks. And when you look at some of them and say, look, they were high flyers and deserved the growth multiple that they were given. I think for some of them now, you can look at them and say, I don't know, it's pretty hard to argue they should be getting that growth multiple. Now they're ferociously profitable, and it's not like they're going to go bankrupt tomorrow or anything like that. But market value is a function of earnings and the multiple for projected growth. And if we all of a sudden wake up and say, you know what, we got to bring down those projected growth multiples for these stocks, it could really surprise and hurt the markets pretty substantially. So anyways, folks don't seem to be too worried about that, given how the market's been partying. But it seems like one of those, less sort of fundamental, but more sort of technical, hidden mines out there that, who knows, maybe could come back to bite the market. So let's talk about Amazon real quick before we wrap up the earnings part. So they delighted markets. This morning, I think they were up like over 9%. Maybe that's come down a little bit, but that's a big jump for a stock with that much market value. It's a lot of market value created overnight. It seems, from what I could tell briefly skimming the reports, that it's mostly due to profitability in their AWS business, their web hosting business, and it's their data cloud business. It does not seem to be being driven by commerce. It's not like, hey, people are buying so much stuff on it, goods on Amazon.com, that we're getting these, beat performances or rosy forecasts that we're putting out there. But that being said, I did see a headline that just said, hey, did Amazon just cancel the recession? Right? I'd love to hear your thoughts. And in general, to my earlier point about, the cardboard companies and the logistics companies, I mean, it does sort of seem that we're seeing, or do you agree that it seems like we're seeing the companies that represent kind of real commerce happening in the world do seem to be struggling here in this earnings season?
Well, kind of yes and no. I mean, it's really what you kind of pick. I mean, for instance, heavy truck sales are off to all-time highs, right? So, there's a lot of demand for heavy trucks. And you take a look at FedEx stock as an example. FedEx is doing fantastic, stock price wise. Caterpillar just hit all-time highs. That's one of your main drivers of industry, right? Caterpillar. They make trucks and tractors and plows and all kinds of stuff, and their stock's just kind of moon shooting right now. So there's
sorry to interrupt, but on Caterpillar, is that like a direct beneficiary of like all the stimulus spending from the Inflation Reduction Act? Okay,
absolutely,
So they're standing right there by the money spigot. Yeah, got it.
Exactly. And so but again, the shipment, FedEx is doing fine. UPS had strike problems. I think they're getting most of that resolved. So they'll probably play a little bit of catch up here, price wise. But like I said, there's a lot of evidence that and again, going back to Amazon, a lot of the reason for the jump in the stock price today is the earnings were a lot better, revenue was up, across the board, but a lot of it was 27,000 job cuts, a lot of cost cutting internally. They consolidated some of their businesses. They reduced spending in areas like telehealth and other stuff that was non-profitable. So they've really done some cost management, and that's really cleaned up their bottom line a bit. And that's really kind of the main driver for the stock price jump is this. They've really done a good job of managing their expense side of their business and helping push them more towards profitability and higher margins. So that was good news. But, there's certainly some anecdotal evidence, of things like, we can certainly pick up these kind of one-off things like yellow freight lines, going out of, filing bankruptcy, certainly not a good thing. But take a look at companies like, Union Pacific and the railroads, they're doing fine. So it's kind of really hit and miss within the economy. But again, part of it goes back to where the money is being spent. And a lot of that Inflation Reduction Act is, resulting in a lot of that push, right? Federal expenditures, I just put a chart, an article out on this just recently, but federal expenditures have turned up sharply over the course of the last couple of quarters, which corresponds with the stronger economic growth reading that we're getting this year in particular. But a lot of that's just coming from federal expenditures actually hitting the markets now.
All right. And does that federal expenditures number that you're talking about, does that also include interest payments on the debt, or is that separate?
No, that's just gross federal expenditures. So yeah, interest payments on the debt are included in that.
Okay, which we also know. So yeah, you have to haircut some of that increase because it's not going into the economy; it's just going to creditors.
Right.
Yeah. All right. Well, that's a good segue then into the next news item I wanted to talk about with you, which was the Fitch downgrade of America's credit rating.
Yeah.
Right. Kind of came out of nowhere, right, for a lot of people. Not a surprise, but as soon as that came out, you had kind of a mobilization of the DC economists and the Wall Street, all of Wall Street, right, basically saying, hey, this is reckless and this was not necessary, and there's a whole bunch of reasons that we need to caveat this, and it shouldn't matter, and they're trying to sort of talk down or even maybe discredit the decision. I guess the big question I have for you is this meaningful in any way to the markets?
It's a nothing burger at the end of the day. People forget history very quickly. If you go back to August the 11th of 2011, we were in the middle of a debt ceiling debate. The market had just picked up basically all-time highs a couple of months before that, when Japan was then hit by a earthquake, undersea earthquake that turned into a tsunami that flooded the Fukushima plants, created a nuclear meltdown, and Godzilla came back. So, we got this big crisis in Japan right in the middle of this debt ceiling debate. And at that time, S&P downgraded the U.S. debt from AAA to AA plus with a positive long-term outlook, and cited that the reason for doing that is because of this debt ceiling debacle that was going on, and the fact that, despite the fact that we're, passing a debt ceiling, we were not taking any steps to reduce kind of the fiscal irresponsibility in Washington over spending. And interestingly enough, 12 years later, almost to the day, you have Fitch coming out quoting exactly the same thing, saying the reason that they lowered the debt rating from AAA to AA plus with a long-term stable outlook is that because of this debt ceiling deal. We passed this debt ceiling deal with no cuts to the budget, no reduction of spending, no real controls. We haven't passed a budget, period, since Obama took office in 2008. There has been no fiscal responsibility in Washington since 2008. We continue to fund government based on what we call these continuing resolutions. And every time we pass a continuing resolution, that increases the federal spending by 8% automatically across every budget. So whatever your budget was last year, it goes up by 8% this year automatically every time we pass these continuing resolutions. This is why the debt continues to spiral. We're at $32 trillion in debt and climbing. And this is why the debt continues to increase. So, this is not a surprising issue. And again, if the U.S. was a corporation, it would be a CCC rated junk bond because we spend a lot more than we bring in revenue. But because we can print our own currency and we're the premier store of reserve currency everywhere in the world, and that's not going to change, that's why that's why you have the AA plus. But again, this doesn't change the dynamics of the bond market. What sets the price of the bond market is supply and demand for bonds. That's driven by the credit markets. And as long as the U.S. is a reserve currency, which it will be for a long time, because there's nowhere else to have a reserve currency. And that's just, we keep talking about this ad nauseum, but that's not going to change. So the credit rating means absolutely nothing. Now, go back to 2011. At that time, when the market when the S&P downgraded the debt, at that point, the stock market fell about 8 to 10%. Over the course of the next year, it was up 20% from that low, that kind of knee-jerk reaction to the downgrade. Yields on the 10-year Treasury rose a bit. We had a kind of knee-jerk reaction higher at the time of the downgrade, obvious at that point. Over the next year, yields fell almost 2 full percentage points over the next 12 months. So there was a huge rally in 10-year Treasuries over the next couple of months. The dollar rallied sharply. It was up about 8%. It was up about 3%, which is a big move for a currency. And stocks did fantastic. So this, at the end of the day, this downgrade will mean absolutely nothing in the grand scheme of things.
Okay. So yeah, sounds like you're saying the S&P downgrade really didn't do anything except raise eyebrows for a short period of time. And then we had a massive rally in bonds, stock market did well, dollar strengthened, all the things that people didn't think it was going to do when that warning was initiated. Okay. Well, okay. That's a good segue then into my next questions for you, which is, okay, we actually are seeing bond yields continuing to rise here. They actually spiked pretty dramatically this week, maybe in some response to the Fitch downgrade.
No, it was all in response to the downgrade. That was the whole thing. Okay.
So two questions around that folks are asking right now. I'm seeing a lot of comments and emails around this. One is, whoa, like how high is this going to go? Right. I'm going to intuit. You might think, hey, it's kind of a sugar high, right? People kind of panic from the headlines. It's going to come back down at some point. But increasing number of questions of, hey, is the TLT trade in trouble? Right.
No.
Okay. So if you can you talk about that? Because I've gotten enough emails that I know that there are enough folks that would love to hear your latest update on that.
Well, I mean, look, this keeps coming back. We're in the middle of a transition period for bonds. I mean, this has been something that we've been talking about for a while. The dynamics haven't changed of what drives bond prices. It's economic growth, inflation, and wages at the end of the day. Wages are coming down, inflation's coming down, economic growth is going to slow more. And that's going to drive inflation lower. That's going to drive interest rates lower. And interest rates are simply a function of economic growth and wages. And inflation. If those are coming down, interest rates are going to come down. But that takes time. See, everybody keeps expecting like, oh, I'm going to buy TLT today and I'm going to make a whole bunch of money tomorrow. No, this is something that's going to take 12, 18, 24, 36 months to work out. And you've got to get the Fed to start cutting rates here somewhere. So you're buying in advance of what's going to happen over the next 12, 18, 36 months. And if you're in this camp thinking a recession's coming, that's exactly what's going to drop rates lower. So, the only dynamic, and again, I heard some guys out this week and they're talking about, oh, interest rates should go to 5%. What's his name? He shorted the 30-year Treasury this week, and I can't remember his name off the top of my head. But anyway, he's a hedge fund manager.
Is it Ackman?
Yeah, Ackman. So he shorted the 30-year bond. So I got all these emails like, well, Ackman shorting the 30-year bond. Yeah, for a trade, that probably makes a lot of sense. But if you're shorting, if I'm buying options to short the 30-year bond, I'm expecting something to happen over the course of the next couple of weeks to a month or two.
Days to weeks, yeah.
Yeah. And I'm probably hedging another position in my portfolio that, I want to hedge off. That's not my bet. My bet is longer term that says, look, it's a function of debt. You have a record level of debt in the economy, period, across the board, whether it's credit, whether it's the treasury debt, consumer debt, whatever, you've got just a record level of debt that was all built upon very low interest rates. So if interest rates go to 5 or 6 or 7% and not even stay there, but just think about this. We had interest rates go up to 4%, 4.25% earlier this year, and you had a bank crisis, right? Because what happened was interest rates went up and it suppressed all the collateral in the banks. What do you think happens to the banking system at 5%? What do you think happens to the banking system at 6%? What do you think happens to the stock market at 5 or 6%? If I can go put money into a money market account at 5 or 6% interest, why do I need to be in stocks, right? So the point is that if rates start rising that level, you better bet your booty that Janet Yellen's already been on the phone with Jerome Powell going, what are we going to do here?
Yeah.
Right. And that's why they immediately came out and said, this is ridiculous. And, this is stupid, the debt downgrade. Oh, by the way, they said exactly the same thing. Ben Bernanke said exactly the same thing in 2011. He says it's ridiculous. And they're using outdated data on this downgrade. But the reason is because that spike in rates is dangerous, and it's not going to last long if it does. I won't be surprised if this little spike in rates doesn't completely reverse in the next month.
Okay. All right. Thank you for that. Hopefully that gives some of the people that were having a little bit of heartburn over this a little bit of comfort, but it sounds like you're still committed. You are not changing your strategy at all in terms of your bond.
Right. But look, it's about fun. Look, this is a fundamental trade, right? And you've got to start, you've got to think, and I've gotten tons of emails from people all week. Like every day the interest rate moves a smidge. It's like I get all these emails, but my TLT trade, okay, is it a trade or is it an investment, right? You've got to make your decision. If you're trading TLT, yeah, you got stopped out. You should have sold it already, right? I'm not in this for a trade. I'm building a position, and I've been building it over the course of the last year, and I'm going to keep building it, because I know there is no way around it because of the debt and because of economic growth and inflation. There is no way that the 10-year treasury yield is not going to 1% or less over the course of time over the next 2 or 3 years. And I will hold this position until we get to that point, and then I'm going to sell it. I'll sell everything and go long equities. But that's just a function of fundamental economic dynamics. You cannot support high interest rates in a heavily leveraged debt environment that was built on low interest rates. It just doesn't work. Yeah.
And I want to add weight to this, right? Because you've been, and your partner, Michael Leibowitz as well, has been very consistent on this, which is the big opportunity right now is you get paid an attractive coupon to be in safe bonds right now. Yeah. And there is this, what you think of as a sizable enough potential for you to feel quite confident about it, that rates are going to have to come down once inflation is hopefully under control, for all the reasons that you mentioned. And they're going to come down, in your opinion, relatively substantially, which is going to cause the longer end of the bond duration curve to really substantially appreciate. So it's one of those great opportunities where you get income while being in safety with potential material upside optionality value. So yeah, you're basically saying that's why I'm committed to this thing, folks. I'm not trading in and out of it on a daily or weekly basis.
Right. Yeah. And look, and this, the other side, why has the market been rallying? The market's rallying because they're betting on the Fed to cut rates. If the Fed cuts rates, interest rates come down. So if you're betting on a Fed rate cut anytime in the next 12 to 18 months, yields have to come down. You can't have high yields and Fed cutting rates. That's just not going to work.
Yeah. And also too, like, you say the markets are rising because of the expectation of the Fed cutting rates. And that may very well be true. And we've talked about how when you look at history, when the Fed actually starts cutting rates, stocks actually don't do well, usually for the next couple of quarters, but it tends to be one of these buy the rumor, sell the news turning points, because it's been the rumor of the rate cuts that have powered the markets higher. Once that's happened, there's no more rumor to be driving the optimism anymore. It's now an event in the past, right?
Yeah. Well, no, it's just like today, the market, was kind of weak this morning when futures were early, and then the employment report came out that showed 189,000 jobs, weaker than expectations. And they revised down last month's employment report to 180 something thousand jobs from over 200. And so that immediately the market digested that real quick and go, oh, that's bullish, because that means job growth is weakening. That means the Fed's closer to cutting rates. So the market goes, oh, well, then we need to push stocks up, because if the Fed's going to start cutting rates, that means more liquidity, less tightening. So that's good for stocks. And so, but that's how rapid that these markets are trying to price in expectation for lower rates.
Man, it's crazy. Yeah.
Well, look, you're just dealing with a casino now, right? It's all about betting on, and again, this goes back to the bond trade, right? Everybody wants the trade that's going to make them money right now. That's a casino bet, right? So, I'm looking for the advice that says, okay, buy this and tomorrow I'm going to make a whole bunch of money. That's a casino bet. If you're investing, you've got to invest for a long-term time horizon on something that is almost guaranteed. Now, nothing is guaranteed in life, right? Nothing is guaranteed. But there are some things with a very high probability of success given time.
Right. And that's just to use your analogy. There's the casino bet on like, okay, what's the roulette wheel going to come up with on the spin?
Yeah.
But then what you're talking about is, hey, let's bet on the casino, right?
Right.
Where we know they're going to make money over time, right? The odds are in their favor in the long haul.
Exactly. But it's just interesting. I mean, that's why we buy some companies, right? We buy Apple because Apple just cranks out sales, every quarter, right? And sometimes it's a little weaker, sometimes a little stronger. The question for me has always been with Apple is how many people can keep paying $2,000 for an iPhone?
Right.
What's interesting is that if you talk to people, and I'm just curious, if I ask you, how much of the cell phone market does Apple own?
I don't actually. I'm just to throw it out there. I'm going to say less than we expect.
Well, just pick a number between 0 and 100%. You think it's 50%? I mean, everybody has an Apple, right?
I'm going to guess 21%.
Yeah, you're pretty close. It's about 25%. But again, but it's like Starbucks, right? There are so many great coffee companies out there, these little mom and pop coffee companies that make so much better coffee than Starbucks. But Starbucks is a household name, right? So if you go into a city, you don't know that, you don't know Jenny's coffee shop on the corner, but the Starbucks across the street, you go there because kind of know what you're going to get. And so there's a lot of these companies that generate sales and revenue, and you think that, oh, everybody goes to Starbucks. It's not really the case. A large majority of people are Android phone users, but it seems like because of the marketing and kind of the cult personality around Apple and everything else is like, oh, well, everybody's an Apple user, but that's not really the case at all. But you have to then equate that back to valuations. And we talked about this with NVIDIA as an example. NVIDIA, to justify 40 times price to sales, would have to own the entire GPU market. That's never going to happen.
Right.
And at $3 trillion, you're kind of saying that Apple is going to own the entire smartphone market, right? And that's not ever going to happen, right? So, and again, you just kind of have to put some of these things in perspective, but just realize that a lot of this valuation that we attribute to it is great marketing. These companies did great marketing. They created a cult of personality around their products. And you think that they have a much bigger market share than probably they actually do.
Yeah. So great point. I got to talk about the inverse of that for a second, where you have companies like Google, right? You mentioned Android phones, right? And that's a platform that Google created, much bigger market share of the mobile phone market than Apple. But you look at the online search market share. I don't know what the latest numbers are, but I know, having looked at it a couple of years ago, I mean, it was in the 90th percentile.
Yeah,
right?
Everybody, yes. But it's Google.
And so there are some companies out there that actually do have pretty much the entire market captured, which, hey, great, Google's done well as a stock. But like, what are antitrust regulations for? You've got, how much more of a monopoly do you need? Do you need the last couple percentage points till they get to 100?
Yeah, that I've had, this is the problem is that probably, and I've talked about this before, is that, we talk about a lot of the problems that have been created in the economy over the last, decade in particular. Wealth disparities and CEO pay that's all out of whack. And, there's a lot of these companies that have become such massive behemoths that, really probably they are a monopoly, but it's hard to say that because, again, is Meta a monopoly? Probably, we should probably think about breaking Meta up, right? Into, Meta and Instagram and those other things. But then you say, well, wait a minute.
But when you combine Meta and Google and you look at the online advertising space, you can say they're definitely a duopoly.
Right. But it's a duopoly. But then you go, it's about monopolies are saying that basically no other competition come into the market. They price out all of their competition. But then you can say, well, look, there's other advertising companies. Bing has advertising and search revenue, and not very much, but Yahoo, believe it or not, still out there. It's got it's generating some ad and search revenue. So the problem is that I think we probably we're gonna have to come back and at some point re-examine what we determine to be a monopoly, and change some of that law around it if we really want to try to start evening the playing field across companies. Because under the current definition of monopoly, it means that there's no other ability for other companies to compete. But yet in today's world, we have these massive companies, but there's still a lot of other companies picking off at the, kind of the corners of the playing field.
Yeah, but I mean, look, we could, I don't want to veer too far off from the focus of our weekly market recap here, but the way in which, and I used to work for Yahoo, so I know a little bit about this space. The way in which they have lobbied in DC, and of course these are companies that have spent gazillions of dollars in DC, so they already have the politicians pretty much in their pocket. But they've said, well, is the consumer being hurt here? Look how great Google search is, right? And the answer is yeah. I mean, search is great, and it didn't exist 30 years ago, and it's this wonderful thing that everybody has more or less free access to. But how much better would it be, right, if we had stronger competition that could really, keep Google on its toes and continuing to innovate and all that type of stuff. And so, yeah, when you have 90+% of the market and you keep a couple of straw man guys just stumbling around just so you can point and say, well, that guy actually has 1% of the market,
we haven't killed everybody yet.
Yeah. All right. Well, look, a couple of things you mentioned, I want to just tick off here before we get to kind of your trades and the back half of this discussion. This is in no particular order, but you talked about how a lot of Amazon's profit beat came from their cost cutting, and there was a large part that had to do with layoffs and with getting rid of contractors and whatnot. I was having a conversation last night explaining to somebody really what Elon Musk has done at Twitter, or now X, right? And how I think it's going to have really long-lasting repercussions, certainly in Silicon Valley, but probably eventually elsewhere, where, when he took over Twitter, he very quickly got rid of 75% of the workforce. And look, he's a polarizing figure. I'm not saying you have to like him or be a fan of what he's doing, but Twitter's still out there, and he's been sharing data relatively recently saying that they had their highest number of monthly average users and monthly average time spent on Twitter and whatnot. The company hasn't died, and I think he's really defined like what an essential worker for a company is, and he's caused companies to say, look, we can probably get along with fewer employees, probably substantially fewer employees than we've thought for the past long time. And so my question to you, Lance, is do you see us, forget about the risk of a recession and layoffs that might force on companies, putting that aside, assuming it doesn't materialize, do we think that companies, at least maybe in the tech space, are going to move forward being a little bit leaner and meaner given what Musk has shown is possible?
Yeah, I think AI is going to do kind of the yeoman's work on that front. I mean, and again, it's the big thing with AI is that look, we replaced a lot of low end wage workers with kind of robots, retail, and there was interesting kind of debate about self checkout at grocery stores, right? Because now all of a sudden there's no more checkers, you have to check yourself out, and there's been kind of a lot of debate around that recently. But so we replaced a lot of lower end jobs, with robotics or automation or self-service, but we haven't really touched the high end jobs yet so far. And the big thing with AI is hey, you're a programmer, AI will program. It's not perfect, but I can, as a novice programmer myself, I can go into Chat GPT and have it program stuff for our Simplivisor page, and I can send it to my coder and say, would you double check this and make sure it's good? But it saves a lot of time. And the same thing, it can replace paralegals and lawyers. And it just, there's all of a sudden, there's something here that potentially impacts the jobs at the higher end of the wage paying scale. And that's a big cost savings for companies. So if companies are looking to shore up profitability, and again, I posted some charts on this just recently looking at wage, the wage to profit ratio, the profit to employee ratio. If companies are fighting in an environment, and again, we have this environment of slower revenue growth. We talked about this last week in our article, that since 2009, revenue has grown in total. Cumulative revenue growth in the S&P since 2009 is up 104%. Profit margins are up almost 400% on the operating front. So the way you create that disparity between $1 worth of revenue and $1 worth of operating earnings is through accounting gimmicks and cost controls and those type of things. So now all of a sudden, if the economy slows and revenue growth slows, the way I keep my profit margins up is by reducing my highest cost in my business, which is labor.
Right. You're making me think, Lance. So
That's good.
Yeah, thanks. Rarely happens, but yeah. But I think increasingly more and more, I think of the people watching this video, right? Many of whom are professionals. They've just got this unease in their gut around AI, right? Where they kind of know the trajectory, which is what you just laid out, which is over time, it's going to increasingly creep up the talent stack and just start, displacing jobs that maybe people who really invested in their education and they got big degrees and they've got big titles at their work, they thought they'd be sort of forever protected, and are now maybe thinking like, that really might not be the case. Like, what's that going to mean for me, right? So we have three things that we just mentioned. We mentioned, Elon Musk just showed companies that they maybe need less people than they have otherwise assumed. Secondly, we've got the threat of AI and other types of new technologies. And then third, we may have a recession here with a lot of layoffs, right? Who knows? As a financial advisory firm, maybe like your personal finance guys, like
Yeah.
Richard and Danny, like, can you sit down with somebody who just says, hey, look, I'm successful in what I'm doing right now, but I'm worried that in 1 year, 5 years, whatever, I might get taken out of the game, at least in my current role, by one of these, big threats that I just listed there. And is there any kind of pre-gaming or stuff I can be doing now to, in case that happens, I'm going to be less impacted than if I just slam into it blindly?
Well, look, we talk about this all the time, and unfortunately, people don't solicit a financial advisor early in life. It's interesting. In life, you need three things. You need a good accountant, a good lawyer, and a good financial advisor. And you get those things early in life. And yes, you're going to pay for it. But, everybody goes right now because markets just going up. It's like, oh, why do I need a financial advisor? I just throw my money into some ETFs. They're low cost. And this is the big thing you hear about in the media all the time, is like, oh, just buy some low cost ETFs. Why pay an advisor? Just buy a low cost ETF portfolio. You're fine. That's not what a financial advisor does. You don't need a financial advisor to pick stocks for you or to buy an ETF. Yes, you can do that on your own. What you need a financial advisor for, if he's good, is to be your financial advisor and say, this is what you need to be doing. Now, unfortunately, what happens is that most people don't come to us until, oh, I'm getting ready to retire next week. I need to do a financial plan. And then we do the financial plan for them and go, you probably shouldn't be retiring next week because you're not anywhere near retirement, because you have all these other liabilities, you have all these other problems, you got health issues, you got family issues, you got all this other stuff that you need to factor in to this. And this is something that had he started his financial planning 20, 30 years ago and said, hey, if I want to be here by the time I get to retirement, I need to be doing these things now, right? Investing in the markets and saving this money and, not getting into debt and paying attention to my salary growth versus my expense growth, making sure I'm not having any creep and doing a regular evaluation. But see, nobody wants to do that work because it requires you to be responsible for your money. And that don't tell me what I can spend my money on. I want to just go YOLO, right? I want to do this and I want to do that. And that's fine. Nothing wrong with that, but you're going to pay the price for it eventually down the road. And what separates people out that have money versus don't have money, and this is the whole millionaire next door thing, is that there are some people that just naturally have this inclination of living within their budget, living within their means, and saving money and being cognizant of these things versus, racking up a bunch of debt, making a lot of bad decisions, over time. And this is what has happened to a lot of people. A lot of people want to blame, oh, it's student loan debt, that's why I'm in trouble. No, student loan debt's not why you're in trouble. Nobody required you to take out the student loan debt. That was your decision and you did it. But that's not why you're in trouble. The reason you're in trouble is because you're spending too much money everywhere else in life and you're not paying attention to that one debt and focusing on getting it paid off. You're doing all this other stuff that you probably shouldn't be doing as well. It's never one issue that's a problem. It's always the culmination of all the bad financial decisions that people are making based on their income and their choices that they're making.
All right. So,
And sorry to wrap it up, a good financial advisor will help you with all of that. It's worth the money you'll pay them to do the financial planning. Sorry. Now go ahead.
Yeah. No, I mean, that's the rubber I wanted to have meet the road here for viewers, right? Which is, look, you may have your money allocated in a way that you feel very comfortable with right now. Great, that's fine. And I think when people think about financial advisors, they tend to think about, okay, great, how do I allocate my portfolio, right? And let's check it out over a period of time. Yes, that's a very important part, but that's really the doing part, right? That's the what. I think this sort of financial planning part is very much the why and the how, right? Like, okay, why am I doing all this? Well, I want to have money in the future, more money in the future. Well, why? Because I have these life goals, right? I want to be able to retire at this point. I want to be able to buy this house. I want to be able to send these kids to college. I want to be able to, take care of these life dreams I have or these life needs, right? And that's what a financial advisor is really good for, personal financial planner, right? Is helping you think through all that because they have done this a zillion times. They know what the process is like. All of the rest of us are doing it for the very first time. So we don't know what we don't know, right? So the questions they ask us, the exercises that they put us through, super helpful from that standpoint. They get your why locked in, but then it becomes, okay, great. Well, you're going to need about X amount to do all this, right? Then you get to the how. Well, how am I going to do that? Well, you're going to have to earn this much money and you're going to have to be able to get this much return on it, right? Okay, great. So, if I got to earn X amount, I got to figure out how to do that. And then I can build a portfolio to give me the growth that I need on top of what I'm earning.
That's not exactly right. Right.
Okay,
so
correct it.
No, and you're making the right point, but you kind of put the cart before the horse. And the issue is that the investing part is the least important part of the entire process. So the financial planning part tells you all the things that you need to be doing. The one thing that builds your wealth is saving money. That's how you build wealth. You build wealth by saving. And what everybody wants to try to do is save as little as possible and then have the market do all the work of creating the wealth. That's where you wind up taking too much risk, and that's where you wind up losing a bunch of money and doing all kinds of bad things. The saving the money, right? This is why people email me and they're like, here's where I am. What do I need to do? You need to start saving 30 to 40% of your income. Well, I can't do that. Yes, you can, but you're going to have to make some decisions, right? You can't be driving a Lexus today. You're going to have to be driving a 10-year-old piece of crap, but it's just part of it. But you have to make these decisions, but you've got to start saving money. You've got to create cash flow by getting rid of debt. You've got to start saving a lot of money because saving is where your wealth comes from. And if you want to build a lot of wealth, you start a business that you eventually create wealth from. And that's where the vast majority of wealth is created, is by people who started independent businesses. But you can still create wealth by saving. All the investing part does is make sure that your savings equates to the inflation adjustment in the future. And make sure that your savings have the same purchasing power parity in the future. It is the least important part of your wealth building process.
Okay, very important to underscore. And I just got to add one more leg to the stool for it to be complete, right? And I mentioned it super briefly earlier, but it's the earning part, right? So you got to earn, you got to save what you earn, and then you got to protect it from inflation, right? And that's really what it is, right?
Perfect.
And again, that's where you get to the how, right? Where if you say, okay, these are my goals, and it's like, well, great, then you got to be earning X, right? And you got to save this much of it, and then you got to keep it, on pace with inflation by the investing part. So again, I don't want to beat this horse too dead, but
it's a great point.
It's not just stocks and bonds, is what I'm trying to say. The role that a good financial advisor, financial planner can play for you. It really is your financial quarterback who is helping you put together the game plan, telling you where the goal line is, and telling you, how aggressive you got to be in your plays to get to where you want to go. Because otherwise, you either got to, you better ratchet back your goals and just say, look, they're not that realistic. Let me come up with some realistic ones. Or you got to say, okay, great, I got to be more aggressive than I thought in terms of how I'm going to be spending my time to earn.
So I was listening to a podcast this morning, and he was talking about he was a Navy SEAL, and he was talking about his time in the SEAL training, and that his SEAL instructor was legendary. It was a legendary SEAL instructor that he had, and he said, look, everybody thinks the SEAL and the instructors are just going to be yelling at you and they're mean all day. He says, my SEAL instructor started out, he said, look, every morning you get up, first thing you do is you make your bed. Second thing you do is you brush your teeth. Third thing you do is get to breakfast. You've already accomplished 3 things for the day. And now you've got your whole day ahead of you. And he says, I promise you that the rest of the day is going to suck. And all your job is to do is get to lunch. And if you can get to lunch, the rest of your day is going to suck. And if you can get to dinner, you've accomplished that. And then you get to go to bed again in that freshly made bed that you just made up this morning. And then tomorrow is going to be even more challenging, but you're going to get through it because you're not going to quit today. You're going to quit tomorrow. And the point he was making is that, and this relates to life in general, is that I hear too many people complain about the fact, well, I don't make enough money. I can't save money because I don't make enough money. Hey, I get it. It sucks, right? And and we have choices though. We can, and I saw another video from a guy this morning. He's like, I'm just trying to figure out how to work less every day. It's like, why? Figure out how to work more. If you want to make more money, again, to your point about earning, right? If I want to earn more, I've got to develop a skill base that will earn me more, or I've got to work a couple of extra jobs. So if I'm working an 8 to 5 job, I've got 5 to 9 to do something else, right? That I can just start a business on the side or whatever it is to start earning more money. But the point is to how to and use your time figuring out how to earn more. Your challenge is just to figure that out every day. You can quit tomorrow, but today, keep figuring out how to earn more. And tomorrow, figure out how to earn more and quit the next day. So, the whole point to this is we've got to save more, but in order to save more, we got to earn more. And if we can earn more and save more by reducing our cash flow, we can build wealth. That's it. And it's just that simple.
Okay. This is taking me in what I think is going to be a really interesting direction for you and me. Not entirely sure the audience is going to want to come with us on it. So before I put up this next topic, let's talk about your trades real quick. Sure. I'm presuming maybe you haven't done that much because we talked earlier about how you're kind of in a wait and see if this correction is going to happen, but you tell us.
No, that's it. We have been adding exposure to our portfolio again over the last couple of months on this rally. So we're still, so our portfolio can swing in terms of how much exposure we have to equities. We can go from 60%. So our portfolio model is 60-40. So 60% equity, 40% bonds. But that equity balance can swing from 60% all the way down to 15% equity, but it can go to 70. So right now we're at about 55% equity in our portfolio. So we're sitting on some cash right now. And so we've been waiting for this correction to occur to put that 5% to work. And if we get a really good correction, then we'll probably go over 60% in terms of our total allocation. But no trades this week. We've been waiting for this correction to give us our next opportunity.
Okay. And before I get to my other crazy topic, let me talk real briefly with you about a piece that Michael put out this week, which was talking about how, from his perspective, you can make a pretty good argument that bonds are looking better than stocks right now as a longer term investment. Yep. And if I read his article correctly, given where valuations are right now, you can make an argument that future stock market returns may not be nearly as robust as they were, say, for the past 15 years or so. And he talks about how bonds obviously are offering more attractive return now than they have for a good while. And he says that you can look at these two current situations where how equities are valued and bonds are valued here. And there's a really interesting moment in time here where if you get the timing right, you could really make some good money here, where he basically says, look, if you get into bonds right now, you're getting that safe return that we talked about. And you've got that potential upside value if interest rates come down, right? If all that happens, and if stocks do indeed, if they're overvalued right now, and when he talks sort of about a lost decade, it doesn't mean that they're just not going to go anywhere for a decade, that there's going to be some volatility, right? Potentially some material correction. So what he's basically saying is you could ride bonds right now, get paid, perhaps even get a really nice rise in the value of the bonds. And then if the stock market gets sort of right priced, then you can shift into that stock market at much better valuations. You can start getting out of bonds, and then you can eventually ride the recovery of stocks. And of course, he's looking at this as sort of a multi-year type of thing. It's not something he's saying, you're going to deploy in the next couple of weeks.
Right.
But Michael's been doing a very good job this year, particularly coming on this channel and educating our folks about bonds in general, how they work, but also the current relative attractive valuation of bonds and whatnot. I just want to see if there's anything about that piece that he wrote that you want to clarify for folks here.
No, the important thing is the rate of return in stocks over the last 13 years. We've done a lot of work on this. Between 1900 and 2008, the average rate of return on stocks was about 8%, which is exactly what you would expect, because that 6% of that return came from a capital appreciation, which equates to the growth rate of the economy over that period of time. Economy grew at about 6% on average. And the other 2%, make up the 8, came from dividends. So the 8% was very normal, and what you should expect. Stocks, and in fact, this is today's article that is on our website right now, talking about the stock market is detached from the economy, because there's a very high correlation between the stock market and the economy long term. You should expect that, because the earnings for companies come from economic activity, right? It's what you and I spent. So over the last 13 years, though, the market has generated 12% in the average rate of return. So in other words, the average rate of return has been 4% higher than what the economy can actually generate over the last 13 years. But in order to get that 4% additional rate of return, it has been dependent upon $44 trillion worth of monetary and fiscal stimulus, either through QE programs or bailouts or infrastructure programs, whatever. So the question you have to ask yourself over the next decade or 2 or 3 is, can you continue to pump in $43 trillion over the next decade? So in other words, another $43 trillion to keep the economy stimulated, to keep things going and all that. If not, then your rate of return is going to fall back to what the economy can actually generate. And that doesn't necessarily mean you're going to have a huge bear market, but it may, but a 3 or 4% rate of return, out of the market may seem very disappointing compared to what you were getting, particularly at a time where, the bond market is going to be potentially doing a whole lot better than stocks. So, that's his point. But the reality is that we've just had such an exacerbated rate of return in the markets because of all this fiscal and monetary stimulus over the last 13 years. You've got to ask yourself, is that repeatable in the future? If the answer is yes, it'll have to be larger. It'll have to be 60 to 80 trillion in the future. Right. There's a function of math in there, but it's got to keep growing at an exponential rate to support the rate of return. But if the answer is yes, we're going to keep doing that. Now you're talking about 60 to $80 billion in government debt. Okay, maybe. But if you think that's not possible, we can't keep generating that type of monetary stimulus, then rates of return have to fall.
Right. Which again, I just want to make sure I'm getting Michael's thesis out here, which is that bonds may be a superior place to be as the equity markets reprice for that potential lower growth environment. And so you spend your time in bonds until that repricing happens, and then you maybe get the ability to then start taking some of those profits in bonds, deploying them at much better valuations in the equity markets. And again, he's painting with a broad brush for the long arc going forward here, but he also was mentioning too that timing is going to be really important here. Again, it's kind of going back to why you want to be working with a financial advisor who kind of gets these macro trends and follows them, because they're going to be the ones to tell you when to be where.
Right.
Okay.
Yeah, that's right.
All right. And folks, that I highly recommend you go read that article, and it's over there on Lance's website. And for some reason, he hasn't actually mentioned it yet in this video, so I will mention it, realinvestmentadvice.com. All right. So I'm going to make this last point, Lance, which I thought about you coming out of this experience. And I know we're talking a lot about the role of a financial advisor in today's video, but it really did make me think of it. So I think, as I've told you, Lance, and I think as I've shared with the audience on Twitter and whatnot, for the past year, I've been learning how to box, right? And I've been in boxing kindergarten. I mean, it's amazing to me how many hours you put into this, and you're still just such a neophyte compared to people that have a lot of experience in this space. And Lance, I know you know this because you were an MMA fighter and you actually taught. So I got to step into the ring for the first time ever 2 days ago. And I was put up against this burly guy, 30 years younger than me. And I basically just got my face pummeled, for 5 rounds. And I was in there to learn and to basically be cannon fodder for this, fighter who's in training to kind of just, have someone throw some punches at him so that he could just get some practice in, right? And what was amazing to me was the exponential difference between somebody with little experience and somebody with a lot of experience. So I'd spent the past year learning, all the basic fundamentals and performing these combinations on the heavy bag, which doesn't punch back and doesn't move, right? Mm-hmm. And I'm going against this guy, and just every single thing I'm throwing, he can see coming, he can move, he can bat out of the way. I couldn't touch the guy, basically. And I was doing everything that I knew to do, right? And of course, too, as soon as I get in the ring and he's throwing punches back at me too, my adrenaline goes up, my emotions flood, and all the training I had goes out of my brain anyways, right? So it's on a scale of deadliness, I was a 1, he was a 99, right? and he definitely would bop me in the face and stuff like that when I was putting my guard down and whatnot. But I mean, he could have ended this thing in the first 6 seconds, right? He was very kind to me. But I walked away from that just having a huge appreciation for those who have been in the ring enough to see enough combinations, to have enough experience, to be able to anticipate what's coming and to know what to look for and to know how to position themselves in advance to not get hit or reduce the power of my blows. And as I left and I was kind of nursing my my wounds, I was thinking actually about how you would have loved, to laugh at me there, given your background, but also like it's a direct analogy for a financial advisor, yeah. Right? Where a lot of people we can read up, we can read all the books, we can read The Intelligent Investor, we can trade our little model portfolios, we can tell ourselves what we think we'll do if the market does X, but when it's really happening, there's so much that we just don't see, we don't pick up on, we get flooded by our emotions, whatnot, because we're either doing it for the first time or we just haven't seen enough of these variations that we can still get surprised by the stuff that we don't know. Where if you're an advisor who's been in the market, you've seen the tape do this 1,000 times, you have a lot more confidence to say, okay, if this is happening and that's happening, then this is, where I should likely position myself right now in advance of it. So I'll stop here and let you opine on this, Lance, but I actually think the comparison is a really direct one.
No, it is. And this is always the amazing thing to me is that, people expect that, just because this is what I do for a living, that I never make a mistake, right? And I never, buy something that doesn't immediately go up. And one of my favorite sayings is always like, I've been doing this for 35 years and I haven't figured out how to buy stocks that only go up. It's just, the point. I've been in so many fights in my life, both on an amateur and a professional basis that, I never left one fight unhit. You always get hit in a fight, and you should always expect to get hit when you want to fight. The difference between a good fighter and a great fighter is how many times did you walk out of the ring the victor? That's the important thing, right? Did you win the fight? It doesn't mean that you didn't get hit in the fight. Did you win the fight? And that means that you got more right than you got wrong over the course of that fight. And yeah, that's very much the case with investing. And I get, people come to me all the time. It's like, oh, I've been buying these stocks for the last few months. I'm doing great in my portfolio. And then I'll see them about 6 months later and like they've lost,
I lost it all. Yeah, very, very common. I hear that all the time.
And I'm like, well, why did this happen? Well, I had all my money in this, right? Or I had all my money in that. And then the market changed, and that's what happens. And a good fighter, when you're fighting them, if you've got a particular, stance that you're using on your fighting technique or whatever, and they pick up on it, they're going to change their style enough to just pick you apart, right? And that's what the market does over time. Is that if the market figures out that everybody's doing a certain thing, that's why when everybody's on one side of the trade, the market does something else, and you never know what's going to cause it. Fitch comes out and downgrades the debt. Nobody was expecting that 2 weeks ago, right? Or even a week ago, nobody expected that to happen. But that's that curve that the market throws at you, that you've got to take that hit and then say, okay, do I need to do anything or not? And if I do, then what do I need to do? And I need to reposition for it. But that's just part of the fight. The question is, this goes back to the financial planning part, is can you win the long-term fight? Can you weather the beating to get to the end of the fight? And that's the important thing.
Yeah. And, I mean, I have people contacting me all the time, from Wealthion about their own wealth building needs and goals. And a relatively common refrain is, well, why should I be spending, 1% of my return? Why should I be giving that to a financial advisor when I can just do the same thing? And what I tell them is, hey, if you can do exactly the same thing as a good, smart, experienced financial advisor, then yeah, you shouldn't work with one. You should pay with them. But most people can't. They don't have the experience, right? And to your point, a fighter, which blows to take because they're not critical blows, right? And you, like you said, you're gonna take some in a fight. What you want to be able to do is take the ones that aren't going to put you out of commission, that also put you in position to then start scoring points, right? And so, again, that's what you're doing here. You're talking about TLT. You're like, yeah, I know I'm going to take some blows early on because I'm not going to be able to predict the exact bottom day to get in on it. But I know that if I position myself right, I'm going to make a lot of money off this trade if it indeed goes the way that I'm pretty sure it's going to go, right? So my point is just like, you want to look for, look, a bad financial advisor is worse than none, right? So don't get a bad financial, you really want to do your due diligence to find a really good one, but find a good, seasoned, experienced one. And I'm not trying to diminish, someone who's starting out in their career and they're their 20s and they're trying to build a client base. But I would really say, find somebody who's got decades of experience doing this, folks. You want somebody who's got the scars of the learning process and whatnot, and leverage that experience. Because like I said, it's an exponential difference between somebody who's done very little of this versus somebody who's done a lot. It's not like they're 50% as good or twice as good. They're like 100% better.
Well, and again, I want to just clarify one point, because this is the most important part. I'm not a financial advisor, right? So I'm a portfolio manager. That's what I do. I manage the portfolio. Danny and Richard and Jonathan Penn and Jonathan McCarty, those are financial advisors. Why you hire them is not for the portfolio management part. That's my job. Their job is the financial planning, making sure that you have the right plan in place, making sure that you're making the right decisions financially in the future, whether it's buying a car or buying insurance. What type of insurance? Do you need an annuity? What are you doing with your healthcare plan? Are you drawing Social Security too soon or too late? Medicare, Medicaid, all these other type of things. That's what you pay a financial advisor for, right? If you're good at managing your own stock portfolio, you don't need me, right? But you still need a financial advisor to do the planning part, to make sure that you're going to get to your goal on time, making sure that you save enough, you're creating enough cash flow, that you're hedging your risk. That's what a good financial planner will do for you. And if they're not doing that for you, then they're not a good financial planner. They should be doing that.
All right, great point. And obviously, same goes true with the portfolio manager, right?
Well, my job is to try to build a portfolio that matches your goals. So that's it. If you tell me that if your financial plan says you need 4% a year, I'm going to build you a portfolio that is generate 4% a year, because that's the most amount of risk that you have to take. Think about it this way. If your plan says you need 4% a year, and you say, well, Lance, I'd really like 5. Well, okay, that's a 1% increase in return, right? So I need to increase your rate of return by 20% to generate that 1% rate of return. So that doesn't mean that I have to increase the risk in your portfolio by 20%. There's an exponential increase in the amount of risk I have to take to generate that 1% additional rate of return. So now you're increasing your potential for loss by asking for more return than what your plan requires. And this is the problem for most investors, and why, after 3 major bull markets, most people don't have any financial wealth. A, they fail to save. A, they fail to invest properly, and they take on too much risk and they blow themselves up. Is they're trying to chase market returns that have nothing to do with their financial plan. So again, if your financial plan says 4%, don't go banking out to get 8 or 10, because you're taking on so much risk. It's like driving a car full speed. You're eventually going to get in a wreck. And the question is whether or not you survive the wreck, right? That's the real question of the day. So you want to make sure and tailor your plan to the point that says, okay, my investment strategy has to match that plan. That's what my job is. That's what I do for our clients.
Yeah. And I got to imagine too, that kind of as a general rule of thumb here, right, that as an investor, individual investor, the more that we can earn and save, the less the ask that we have to put on the investment return part.
Exactly.
And so if we can manage to a lower needed rate of return, we can most likely hit our goal with less risk, right? So in other words, I'm sure everybody like, hey, yeah, great, Adam, we'd all love to earn more, right? Yeah, well, yeah, but I mean, the point is, if you overinvest on the earning part, you can increase your odds of hitting your goal, because the advisor doesn't need to take as much risk, and they have a much easier job of making sure that what you need is going to be there by the time you get to your finish line in life, or can help you get there faster, right? Which is even better, right? So, all right, well, look, we're going to have to wrap things up here, but I knew you were going to enjoy the whole pugilistic part of the discussion here, Lance, given your backstory. All right, well, look, folks, I think we've definitely pummeled the horse dead on this one in terms of the role that a good financial advisor and good portfolio manager can play in your lives. Highly recommend that you find both of those who can help you out here. If you've got a good one who's executing for you in the ways that Lance and I have just discussed here, great, stick with them. But if you don't have one, or if you'd like to talk to one who Wealthion has a longstanding relationship with, thinks is very good, and takes into account all the things that Lance and I talked about in this video, then consider scheduling a free consultation with one of the financial advisors that Wealthion endorses, perhaps even Lance and his team there at RIA themselves. To do that, just go fill out the short form at wealthion.com. Only takes a couple of seconds. These consultations are totally free, no commitment to work with these guys. They just do it as a public service to help as many people position as prudently as possible. And if you've enjoyed this week's video, if you're willing to support me while the East Germans come and collect me and take me off to the lineup that I got to appear in here with my number, do me a favor, support this channel by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Lance, buddy, it's always great to end the week out with you. This week was no exception. I'll let you have the last word as we send folks off here.
Have a great weekend. We'll see you back here next week.
Keeping it pretty simple. I like it. All right. Thanks again, Lance. Everyone else, thanks so much for watching.